Welcome back to another episode of Balance Your Wealth. As always, I'm your host, Ryan. This week, we're diving into some of the questions we hear all the time, not because people aren't necessarily paying attention, but because personal finance rarely comes with simple answers. So today, we're tackling some of those questions head on. We're going to split this episode into two parts. So this will be part one, and then our next episode will be part two, tackling the rest of these questions we've identified. This week, I'm joined by Shaun, Bob, Tyler, Adam, and Nick. And we're going to go ahead and get this kicked off with Shaun. And it's going to be, how much money do I need to retire?
So this is probably the single most question I get asked is how much do you need? And I'm going to start with just a couple of rules of thumb that exist on your chat GPTs of the world. But you could take your salary and multiply it by 25. So if I make $100,000, I'll need 2.5 million. That's kind of a good starting place. But ultimately, like all answers in financial advice, it depends. Everyone's goals are different. And so when I talk to someone, I might hear them say, I'm totally content sitting on the front porch sipping sweet tea. I may have another person that says, I want to travel to Italy, right? I've been working my whole life. I want to go do a bunch of things. Your number is going to change based on how much you spend every month or what your goal is of spending every month. And the hardest question that I have for people when we first meet is, how much money do you spend every month? Because with subscriptions and automatic billing and online pay and all that, some of those things can get away from us. So the first thing I'll always have people do is come up with a monthly budget, go through their expenses, find out where they're actually spending money. And then we can use that number to build out a financial plan and ultimately give them strong advice that, hey, you should feel confident to retire on this dollar amount.
Yeah, Shaun. And I think that's a good frame of reference and a good starting point is what is your income and extrapolating it out. But at the end of the day, most people aren't spending 100% of that income, right? And so that's where your second point of what are your actual expenses? Because that same scenario where somebody's earning $100,000 a year, well, they might be saving to their 401k, they have taxes, they have other things that are going out. So understanding if $100,000 is how much you need to spend, or 70, or maybe like you alluded to too, you want to travel more and that number wants to go up to 120 is going to move the needle. But that's where understanding all the resources and sitting down and looking at a long-term plan can help us figure that out.
Awesome. Primary takeaway here is, think about what your income is, think about what your expenses are, and figure out what your goals are in retirement. And I know that's not a simple answer, but nothing ever really is with finance, right? So with that, we're going to move on to the next question here. So Tyler, one of the other most common questions we get is, should I pay off my debt or start investing first?
Yeah, it's one we get all the time. And, what I tell clients is there is a math equation to this, and then there is also a behavioral piece to it, right? How does debt feel on you? Is it a huge stressor? Are you okay with debt? Personally, debt doesn't bother me as long as I know I'm getting the best opportunity value out there with my money. So that's kind of how I personally look at things, is where's my money best served? Um, you know, Obviously high interest debt, credit cards, maybe even some car loans, things, over 10%, like we likely want to get those out of the way. But when you look at, lower interest debt, mortgages, maybe some student loans that are at lower rates, how I look at that and how I view that is, okay, where is my money best served? Is it best paying off that 3, 4, 5% loan, or can I make more money? Is there more value out there with that cash in my hand? And so personally, I'm a big, hey, if it's low interest debt, and it's not stressing you out, let's figure out a way to make some good return on that money. But high interest debt, big, hey, let's get out of the way. Let's get that dark cloud, out of there.
I think another way to look at it is, what's the hurdle rate? If you've got one of those fortunate people that has a 3% or lower mortgage rate, if you win the Powerball tonight, you probably shouldn't pay off your mortgage. But that's a lot different in 2026 when people are getting 6, 7% mortgages. Now it may make sense to put more money down towards your house or start making that extra payment every month. And so we want to take a look at, what are you getting in the market? What's your risk tolerance allow you to get from a return perspective in the market? And how does that compare to the interest rate that you're going to pay on any debt that you borrow from? And if we can compare those, then mathematically we can come up with the best solution for where should you put your next dollar? Should it be towards debt? Should it be a brokerage account? Should it be your retirement accounts? all of those things are to come into play. So it's not going to be a simple answer.
Yeah, one thing I didn't touch on too is I work with a lot of business owner clients. And so to grow your business, a lot of times you're taking on debt where, hey, that's not bad debt, right? The ROI could be great on that debt. So we factored that in too as well. Is it business debt? Is it personal debt? What type of debt is it? I think makes a huge difference as well.
Also, it depends on where you're at in your financial plan. If you already have your emergency fund fully funded, you already taken advantage of your company's 401k match, you're maxing out your Roth IRA, and you want to put some more money towards debt, that could be a great place. But if you're still starting out, you don't have an emergency fund, you're not quite matching out your 401k, it may make sense to invest in those first before paying off the debt. So building a strong foundation so that you can tackle debt is going to be really important so that you don't have to take on more debt should you have a financial hardship in your life.
Awesome. Thanks, guys. Like everything, once again, not an overly simple answer. There's a psychological component, and then there's the math that Shaun and Tyler are both alluding to. So with that, we're going to move on to one of the next questions we see a lot, and this is an important one, is, Bob, these next two come up in almost every introductory conversation we have: investing in an IRA/401k and the difference between Roth and traditional. You want to help us break this down a bit?
Yeah, that's a huge question we get all the time. And just from a pure specifics perspective, a traditional or pre-tax IRA or 401k, if you are deferring $10,000 into your 401k pre-tax, and you earn $100,000 of income, that money is going in and going to be deducted from your income. So instead of $100,000, the IRS seeing that you earned, you actually only earn $90,000. Money goes in pre-tax, you get that benefit. It grows tax deferred, but when you take it out, it is taxed again at your income rate at whatever it is at that point in your life. The Roth IRA, I just had a conversation last week with someone who thought that it got taxed going in. It doesn't really get taxed going in. You just don't get the tax deduction for it like you do on a pre-tax or traditional, right? So if you earn $100,000, that same $10,000 goes into Roth. That goes in, you still are taxed like you earned $100,000, but it grows tax deferred, and in retirement, it comes out 100% tax free. Now, there's big decisions on which one makes sense, and it has to do with, hey, what's your marginal income bracket? If you're in high earnings years, pre-tax may make more sense. If you're younger in your lower earnings years, Roth may make sense, and a lot of iterations in between. But ultimately, it comes down to having, I believe, a balance between both pre-tax and Roth, but then also taxable as well, and understanding how we take advantage of these. It can be a great long-term tax planning strategy for us.
Yeah, I think one of the big fallacies that we come across in all the client meetings is you have a lot of folks that think like they're too old for a Roth IRA to make sense, right? Like, oh, that's just for super young people who aren't making a lot of money yet. And really, the opposite can be true. Like we see lots of folks who are in retirement doing lots of different strategies to get more dollars into the Roth bucket. And just figuring all that out is not so cut and dry. It's just for, the early days of younger people who are making a lot. So there's a ton of planning opportunity there. And that answer of which one's right is almost always that blend or that balance. We're not blended wealth, we're balanced wealth, right? So it's a balance of those different accounts.
Awesome. Yeah. Great explanation. Help people understand the difference between the Roth IRA and the traditional IRA a little better. Next, we're going to move on to some of the things that definitely get back more to the psychological factor. So, Nick, a situation that never feels good is the market's down. What should I do?
Yeah, well, these days it feels like the market only goes up, so I don't really have to worry about that. But we know that market dips do happen. We plan on them happening. We expect them to happen, and really, it's just the price for admission to get those big double-digit returns when investing in stocks. So when the stock market is down, the short answer is most of the time, the right answer is to do nothing. Just holding on to your investments and not selling or not jumping off the roller coaster while it's in motion is a really good plan. And or throwing even more money at the market when it's distressed or when things are on sale. It can also prove to be a winning strategy. But selling is the last thing you should consider. And I know it's far easier said than done. Like, it's one thing to stand there at the base of a roller coaster and be like, yeah, I think I know how I'd feel to go on that roller coaster. And it's a completely different experience when you're on the roller coaster at the top, looking down, and on the descent, you feel your stomach come up in your chest. And it's a totally different thing. So we know it's easier said than done to be like, yeah, just hold on or just buy the dip. But that's the real investor psychology of why we're here to help you with that.
Yeah, Nick, I don't know the stats off the top of my head, and maybe you do, but your famous chart on what happens if you miss the 5 best days every single year, how hard that hits your returns. So that just kind of leans back to, hey, stay invested, or if you have cash available, let's get it in.
Yeah, it's like half your returns get erased if you just missed 5 of those best days. And almost always those best days happen right on the heel of the worst days. And so trying to time the market when it's being super volatile like that, it's just unnecessary stress that you don't need to put yourself in. And B, the winning strategy is almost always not even trying to play that game.
Yeah. And the last thing I'll add too is we don't necessarily always need to do nothing or add money. There's also things we can do to take advantage of volatility in the market. And there can be tax loss harvesting opportunities. There can be Roth conversion opportunities. There can just be rebalancing opportunities to go ahead and kind of sell things that didn't get hit as much to buy back in, just in rebalancing, not even in adding new money. So oftentimes we try to be proactive during those market dips versus just sitting there waiting and saying do nothing.
Awesome. Yeah, Bob had to put his planning cap on there a little bit and distract us from the real question, but it's a great point. All of our strategies are designed to go through those distressed markets, like Nick said, and like Bob saying, also can present some good planning opportunities. So with that, we're going to move on to our last FAQ question of this episode. Adam, one of the most emotionally loaded questions we get is, am I doing enough? And specifically with that is, how much should I have in an emergency fund?
Yeah, it's a great question, Ryan. Very similar to how Shaun started the segment. The greatest financial advisor answer is it depends, right? Emergency fund, what kind of job do I have? Am I in a stable job security? Is my spouse the same way? Does my spouse work? Like, am I in a government job or am I a sales job, right? That all depends and factors into how much I should have in an emergency fund. 3 to 6 months is the standard generic answer for most people. But if you are in a sales job where you're depending on high volatility of income throughout the year, it may be smart to beef that up to 6 to 12 months just to have that security if something does go down. Probably more importantly than how much I should have in an emergency account is just actually making a decision to have one, right? If you put it into your financial planning routine as something, this is something I have to do, then it becomes as routine as brushing your teeth in the morning. Commit to it, have it in your plan, because nobody knows in life when an emergency is going to happen, whether it's losing your job, going through a natural disaster, something happens to my kids. No one knows when life jumps out and kicks you right in the face. And having funds available is vitally important, right? And we want to make sure that my emergency funds are liquid and available to me when that life happens. So the amount of how much I save in an emergency fund, yes, it's important, but actually committing to having one is probably the most important aspect of an emergency fund.
I'd say another part of it is what does your financial plan look like? If you have a second home, you're going to need a larger emergency fund, because it's not fun if you lose 2 roofs at the same time. And so taking a look at where all your assets, what is your job situation, what is your spouse's job situation, are all very important. So having a financial plan put together so that you know exactly how much you should have, and then having that money work for you, right? Just because it's an emergency fund doesn't mean it needs to be sitting in a savings account earning 0.25%. You should have some in savings because it's nice to be able to go on your phone and move it over to your checking account real quick when the Amazon bill gets too high. But it's also good to have some in a brokerage account where it's earning a healthy return without taking on too much risk, but still providing that liquidity. So getting that emergency fund working for you, having the right amount based on what your goals are and what your financial plan looks like is going to be a key step to building a strong foundation.
Awesome. Great points, Adam and Shaun. Definitely, once again, comes back to your specific situation, how much money you're spending every month, your comfort with risk, your job stability, all that good stuff. So with that, we are going to crown our winner of the week. Shaun had a lot of great points. We're going to let Shaun take his 30 to 60 second rant like we do with every episode. So Shaun, go ahead and tell us what you got.
Yeah, so May time frame right now, allergies full effect. I think it was a long winter for us in Ohio, and it's been a long spring. Things are overgrowing. The bushes all need trimmed. The mulch needs put down. It is time for all that to spring into action. And I think that kind of ties into financial planning because we're making those runs to Home Depot. That parking lot's packed. We got some unexpected bills that are coming up. We're dealing with the toughness of the allergies, but ultimately summer's right around the corner. So weather the storm, put in that work, and it's going to be a great life and a great summer.
Awesome. Yeah, I feel your pain over here with all the yard work and trying to keep up with it. So that's it for this week of Balance Your Wealth. Join us for next week where we're going to do part 2 of our FAQ episode. Thanks for joining us.